The average person in their late 20s in the United States typically has around $10,000 saved for retirement. With a portfolio of this size, you might wonder how much income you could generate from dividends. Although $10,000 won't be sufficient to fully support you in retirement, the dividend income might still be surprising. It could potentially supplement your income or even help pay monthly expenses like paying the grocery bill. In this video, we'll explore various investment options that provide different levels of income, helping you understand how much you'll actually need to achieve financial freedom. At the end, I'll point out a common mistake some investors make and how to avoid it. Welcome to the Daily Dividend, a channel dedicated to personal finance and investing. If you want to improve your financial future, be sure to subscribe and like this video if you find it helpful. There are numerous investment options that can generate passive dividend income. One of the most common is the S&P 500 index. This index is popular because it gives exposure to 500 large U.S. companies with a history of growth and profitability, and it's well diversified across various sectors and industries. Warren Buffett himself recommends investing in the S&P 500 due to its long history of healthy returns. However, if you invest in an ETF or index fund tracking the S&P 500, you'll typically receive a dividend yield less than 1.5%. This is because many of the largest holdings are tech companies like Apple and Microsoft, which pay minimal dividends. For example, Vanguard's S&P 500 ETF, VOO, has a dividend yield of 1.28%, paying an annual dividend of $6.62 per share. With a $10,000 investment, this would result in only $130 per year or $11 per month in dividends. The S&P 500 focuses more on long-term growth rather than generating dividends. If you're seeking a more aggressive dividend income strategy, consider covered call ETFs. These funds aim to generate income through covered call writing, making them appealing to those nearing retirement or looking for additional dividend income. Covered call ETFs can offer high yields but come with risks such as market risk, option risk, and counterparty risk. For instance, the NASDAQ 100 Covered Call ETF QYLD seeks to generate income through covered call writing and has paid monthly dividends for the last 10 years. It currently offers a dividend yield of around 11.5%. A $10,000 investment in QYLD would provide an annual dividend income of $1,150 or nearly $96 a month, making it attractive for generating cash flow in retirement. Another common investment is the Dow Jones Industrial Average, or the Dow. This index includes 30 of the largest U.S. companies and serves as a second major indicator of the U.S. economy. Funds tracking the Dow offer slightly higher dividends than the S&P 500, usually just over 1.5%. For higher dividend yields, consider funds focusing on income rather than growth. For example, the Invesco S&P 500 High Dividend Low Volatility ETF, or SPHD, provides a yield of around 4%. This fund holds only the highest dividend-paying stocks in the S&P 500, leading to lower long-term growth. A $10,000 investment in SPHD would generate around $400 annually, or $33 per month. High dividend funds are popular among retirees for their stability and performance during bear markets, offering regular income. However, another option is investing in individual stocks, particularly those with a strong history of dividend growth. Dividend aristocrats or dividend kings like Altria, which currently offers a 7.78% dividend yield, can be considered. Investing $10,000 into a stock like Altria could yield about $778 annually or $64 a month. When choosing individual stocks, ensure they have positive earnings, good fundamentals, and a sustainable business model. Stocks often experience price dips due to various factors, presenting opportunities to buy at lower prices. Investors with around $10,000 are generally advised to avoid focusing heavily on dividend investing, especially if you're young. Growth stocks typically offer higher long-term returns. A small difference in annual returns can significantly impact your portfolio's value over time. For example, investing $10,000 at age 25 with an 8% return rate until age 65 would grow to $217,000. But at a 10% rate return, it would exceed $450,000. Growth ETFs like Vanguard's Growth ETF, VUG, hold large cap growth stocks and usually outperform the S&P 500 over the long term. However, they have a low dividend yield, under 0.5%, meaning a $10,000 investment would generate less than $50 a year or about $4 a month. Choosing the right investment based on your timeline is crucial. For those early in their investing journey, focusing on growth rather than dividends will likely yield better returns in the long run. You can shift to income investments as you approach retirement. Avoid making the mistake of prioritizing dividend yield early on. as it may not align with your long-term financial goals. And with that, we'll wrap up the video. Thank you for watching. If you enjoyed the video, please like and subscribe. I would greatly appreciate it. Take care.